Welcome to episode 2 of the Podcash podcast, brought to you by Magnetic North Advisors. I'm Jason Preby.
I'm Austin Boniface.
And I'm Mike Shaw.
So last episode we touched on the uptick in number of Americans owning stocks, how it's highest it's ever been, approaching 60% of Americans. So today we kind of wanted to talk a little bit about the DIY, do-it-yourself tools with wealth planning and investing, how they're taking off and growing.
I think, interesting enough, a lot of the uptick in stock investing had to do with the availability and the ease of investing. Robinhood and all those apps made it just so unbelievably easy. And I don't think that was probably the right type of investing, if you could call it that. It was probably more trading, right? Mm-hmm. And I think what we're talking about here today and the change that we've seen is a very interesting study. It's out of RIA Biz. They had an article out. There was a Cerulli study done that shows that, let's see here, let's bring it out. The advised investor segment has grown from 35% to 47%. While those who are considered DIY investors, right, self-directed, has fallen from 41% to 24%. I think that gives me a lot of comfort, actually, that although we got people into investing and they probably weren't doing it the right way, they were trading, they were meme stocks, it was AMC, it was GameStop, it was all those types of things, rather than going, wow, we took a bath in some of these. I mean, some people made money, right, obviously. Yep. But, I mean, these stocks have fallen drastically. And I think what we're seeing is they're going, hey, I'm not investing, but I want to invest. I want to make money. I want to own businesses, own companies that work for me when I'm not working. And they're realizing that they should hire somebody. Yeah. They should look to others to get that advice.
They're realizing that they can invest without trading daily.
Correct.
That the two are separate.
I don't think trading and investing are the same thing. They're Agreed. Two different things.
Agreed.
If you're trading, I don't really believe you're investing. That's a totally different mentality of what you're attempting to accomplish. Investing is going, I want to own companies that are good, solid businesses and will continue to grow and to work for me when I'm not working, right? Similar to our small business owners. The whole point of getting a small business, the whole point of starting something from scratch is to grow something that will continue to make money for you even when you're not working. Mm-hmm. Because eventually you're going to hire people to work for you, to help grow the business. And so you have an asset in the business that you can one day sell. That's essentially what investing is, but it's not taking a brand new idea. It's saying, hey, I'm gonna purchase into an existing idea already. Mm-hmm. I'm gonna purchase into an Apple or a Microsoft or any of these other companies out there, right? Anytime, just to clarify, anytime we're talking about stocks, they're not recommendations. We're just going over that. So. I think that's really, really cool.
Were you surprised to see the result of the study? I personally thought it would have ticked up the other way, and seen more DIY investors. If
you had asked me to give a percentage of DIY investors, and even just percentage change, was it up or was it down, versus those who are working with an advisor, I would have 100% said DIY investors are higher today than they were a few years ago, and that those working with an advisor has gone the other way. I mean, that's what they've been in our industry, in our business. I think that's what they've been saying, right? We're gonna be non-existent. You don't need us anymore. There's technology. There's software. You can just Google everything. Mm-hmm. And I think the reason we're not seeing that, if I really get down to it, is the same thing we're doing with our clients and working on with our business. It's not just about investing. It's about emotional, making sure we're helping guide them through their emotions. It's about planning. being an advisor, being a wealth advisor it's not just investing.
Yeah.
It has to do with making sure we're protecting them, making sure we're guiding them on how much they can spend, and spending as much as they should spend if they're not spending enough, making sure their savings rates are right, making sure their tax situation is right. And I think that's what we're working towards here, and that's why we're seeing a lot more clients that we're onboarding that are small business owners, because we have all of that. We're bringing all of that in, and we're not just focusing on the investments. That's why we have the tax planning side of what we do here. We have the CPA. We do actually do taxes. We can prepare taxes. We work directly with Magnetic North Tax and Accounting in order to do that. We have Magnetic North Insurance in order to help our small business owners make sure that all of the benefits for their employees, for themselves, are aligning with what they're trying to accomplish in life, and bringing that all together. I think one of the big things we see with small business owners, entrepreneurs, they've got a passion for what they do, and they're really good at what they're doing. But that doesn't mean you have good business sense. It doesn't mean you know how to run the business, right? And so a lot of times it's okay to recognize that and say, I don't know how to run the business. Give me guidance. And that's what we're here for, is to give that guidance, the big picture, not just your individual sense, but everything that is you, which is the business as well as the family and everything you're trying to accomplish with that, all your dreams, right? And everyone's is different. But if us as an advisor, all we're focused on, and if we have a small business owner, all we're focused on is their personal life, we're missing a huge percentage of what makes them them, right? And so that's why I think it was extremely important, and why we very intentionally have brought in these other areas of focus for our clients and brought them so that they don't have to go out and try and coordinate themselves amongst 3 different teams of people, and they can do it all right here.
Yeah, easy, right? Just get us, doing the taxes and in-house, having everything, helping clients stay organized is a big one, especially with business owners, because you got stuff coming at you from all different directions. Running a business that's a full-time job, right? And just being able to offload some of these tax tasks and things like that. It's so much more than investing that a financial planner does, right? Think of them as like a financial quarterback, passing the ball to where it needs to go and calling the plays.
One other thing I wanted to ask you guys is, that this study made me think about was, so there's kind of the do-it-yourself route, there's the advisor route, there's a relatively new-ish route in the middle, like the so-called Robo advisors. Seems like every big firm, I know Betterment, I think Schwab has one. It's just risk-based investment management. What's your take on those? Do you like them? I think they have a use for younger clients who really might not need a full-on advisor.
Better than having 80% of your portfolio in GME options.
Right. Yeah, certainly.
It's a step in the right direction. They're not my favorite. It's fine for a younger advisor, right? But also, probably cost 35 basis points, 35 to 50 basis points. What are you paying that fee for if you're not getting anything other than, a 4 to 5 ETF portfolio that's rebalanced annually? Like, you're not getting any value. You could just go out and buy a single name fund and just hold it, right? If you're accumulating. They don't do a ton of planning for you.
I signed up for one just to see what I wanted to walk through and see what it was like. I did this a couple of years ago. The risk questionnaire, it was simple, and I rigged it. So it was like 12 questions. I answered them all. You have to give your demographic information, right? Birthday, your personal feelings on risk, and then like retirement goals and such. I answered every question very conservatively, and they put me in a 10% stock portfolio,
Right.
90% bonds. Like, well, it's not going to do anything for me.
Yeah, I agree with that. I don't think risk. We're all kind of on the same page here. Risk tolerance questionnaires aren't really the answer to decide, what portfolio you should be in. Neither is your age, right? Everybody's risk tolerance and risk capacity is different.
Right.
That's one of the reasons you should consider hiring an advisor or having somebody look at your portfolio. We always tell clients, these things kind of put you in a box. These risk tolerance questionnaires, and
Right.
nobody needs to be put in a box. And
Your money should have a use by date. And if your use by date is over 10 years away, it should be in equities,
yeah, for sure.
right?
For sure, yeah. They're not my favorite. It's expensive. I hate when you see them in 401ks as like the default investment option as a robo advisor that costs 75 basis points or something. And it's like, come on.
For what?
It's just, what are you getting?
Right.
Just buy a target date fund or find an indexed option, an index ETF or something like that, and
Right.
put your money in there. You don't need to make it more complicated, especially when you're younger.
Agreed. What do we got next? What's on our list?
Switching gears a little bit, not talking at all about DIY investors, but kind of back to the consumer. And the article here is from the Wall Street Journal. It's called "The Rise of the Forever Renters." Essentially, individuals, they've grouped them out by income and what percentage is renting now versus in the past. Essentially, the big takeaway was more and more high-income earners are renting rather than owning their home.
Less low-income earners are renting than owning. Less low-income earners are renting. More of them are owning their home,
Right.
which is also surprising.
Exactly, and those two things kind of contradict each other, right? Isn't home ownership the pillar of the American dream?
That's what they say. I think it just comes with convenience, right? And as people age and they're in their prime earning years, right? I think some of them are deciding, maybe I don't want to own a home. Kids are all moved out. Kids are out in college. Don't want to cut the grass anymore. Maybe I want to move back to the city and rent an apartment. Maybe they have a second property up in a lake somewhere. I know that's what a lot of our clients do. Sold their house and the kids moved out and used that money to buy a cabin up north, and now they rent in the city and live a simple life. It is surprising to me, though. I would not expect that stat.
Yeah, some of the things they cited, or they had quotes from people who meet the criteria. The criteria was over 200,000 of household income and renting. They stated your rental budget was higher per month, was higher than what your home budget would be for buying. There's no major down payment or anything associated with that. And then the amenities was a big one, especially for older people.
Right.
Access to a gym right in the building, access to
Wonder how much. It would be interesting to see how much of this is like 55 and older.
It didn't.
Apartments and things.
I don't
like
think
that.
it had ages in the article.
I was thinking the same lines. I wonder how long this trend will continue. And those who are making more, it doesn't mean they're working. It could simply mean they're taking money out of their retirement accounts, and that's how their personal income is here.
Right.
And it really makes me think that it's the baby boomers who are retiring, and they're going, I've made my money. Now I just want to have amenities, and I don't want to have to take care of the lawn. And I don't even want to have to figure out who to pay to do the lawn. I'll just rent and let all of that be taken care of for me. And whether it's renting a house or going into an apartment or a condo, I think there's just so many more amenities that are being built and catered to this generation of baby boomers that they've got the money, and rightfully so. Capitalism here in America is trying to capitalize on that and get them to spend their money with them. And one of those ways is provide the amenities, provide these entire rental communities that are upscale homes, and everything's taken care of.
And it's a lot of, it has a neighborhoody feel. I know some of the nice ones.
Absolutely.
People the same age as you in a similar part of life.
Yeah.
There's a lot of wins there.
It's hasn't been the worst housing market to sell a house into either.
Right.
You know, and
Yeah. Get top dollar for your home and
can buy a lot of years of rent with a $500,000-$600,000 home.
Yes, you can.
Kind of piggybacking off of that, owning a home versus renting. We have another chart up here. This is from Euro Monitor, and it's home ownership share around the world. This data is from 2022. And it shows a couple different countries. We have China with an 89% home ownership, India 87, Indonesia 84, Brazil 72, and the United States at 64. Interesting to see those other countries so high.
You just went over the statistics, so you can't ask us, and we had already seen this. But had you asked me without having seen this, I think I would have put the U.S. right at the top. I mean, I know I would have put the U.S. at the top. I would have never guessed that China would be anywhere near the top, let alone at 89% of
It's a lot of homes.
of that.
And
Right.
India
And India.
too. I mean, just the sheer population
Yeah.
of India.
You go across the top four that are all above U.S. China, India, Indonesia, Brazil. Those are all emerging markets or close to emerging markets, just moving into the developed market world, right? That's really high home ownership. I don't know if they have a different way of how they handle home ownership or what that is. We can keep this short. I just thought it was really interesting,
Yeah.
and that's why we brought it in here, because I would have never guessed that. I'm not sure where European countries fall on this list, but clearly they're below these.
Yeah, I was thinking about that too. The European countries. I wonder if, just as a trend, as economies develop, does home ownership actually go down after peaking? Who knows? It also makes you wonder. 89% of China home ownership in China makes you kind of realize that real estate bubble that they're experiencing over there might be here to stay.
If
Almost
you already have that much home
90% of
ownership.
the people own a home. Who's going to buy the new homes they're building?
Right.
In the U.S., that's 64%. That's down from its peak. It peaked at 69% in 2004. So
To kind of bring this a little bit more full circle and back into what we've been seeing when we work with our clients, and especially in the last 12, 24 months, 36 months, there has been a lot of questions with clients. I'm looking to buy a new home. I'm looking to buy my first home. I'm looking to upgrade. How much can I afford? What's going on? Prices seem to have soared. We still get that, right? Prices have soared. And now, the last 12 months, interest rates are really high. How much can I afford? What should I be thinking about? What are kind of the key points that we've been giving our clients to think about as they tackle, possibly purchasing a new real estate?
I think one that we always come across is what type of down payment do you do? How do you fund a home purchase? One of the things, especially with retirees that are no longer working, one of the things that always becomes a challenge is big traditional IRA pre-tax buckets, and the client saying, I got $1.5 million, I can afford a $500,000 house. It's like, well, that house is $750,000 because you got to account for the taxes. I mean, that would be if they lump sum paid it, of course. But
right.
Those type of questions are it's a case by case basis, so there's no rule of thumb. But that's one of the things that we face a lot with clients I'm meeting with,
especially retirees who are looking at getting that second home.
Yeah.
I think that's one area where we see a lot when we talk about 10 years from retirement, you should absolutely be working with an advisor, if not before then. But that transition period is very huge because many times you're looking to buy a second home. And if you're looking to buy a second home and we haven't diversified the types of accounts that your money is in, and you have everything in your 401k or in your IRA, it makes it very difficult to purchase a second home without paying way too much in taxes. Versus if you plan, we can get the buckets all sorted out between pre-tax, post-tax, tax-free, and we can tackle that goal a lot easier with the exact same amount of money, just planned over 10 years as opposed to 1 year.
Yeah, that's huge. Tax diversity is, you hear us talk about that a lot on this podcast because it's such a common theme that people overlook, right? People who don't seek professional help forget about that all the time. Mike, what factors do you look at when considering buying, renting? How much do you put down?
Yeah, I think it's a case-by-case basis. I think renting is the ultimate flexibility, right? If you are unsure about an area, if you just moved or something like that, even if you have the money, I would encourage renting. Try out different areas, see where you like to live. But as soon, if you're tied to an area, and you have the cash flow, then yeah, I think buying a home is just fine. I think you guys already talked about the different situations to look at. What is the average home sale now? It's like the most it's ever been. It's $465,000, or the median. Sorry. So I think we've seen probably in the last little bit people buying homes with 5% down that maybe shouldn't have bought homes, but again, it's a hard thing to talk about because I think it's situation by situation. I think it's ingrained in people that you have to have a house to be successful, and I don't think that's true.
I agree, and we just saw that in the last topic we covered. There's a lot of high income earners that aren't on their houses, right?
Exactly.
I think people a lot of times underestimate the cost of owning a home, right? Underestimate things like, not only property taxes and mortgage interest and that kind of stuff, but also just like, something breaks, you got to fix it, right? Buying new appliances every couple years, and there's a new roof, there's all that kind of stuff that does add up. Homeowners insurance is a it's not that expensive, but it's important, and I look at my parents, actually, funny story, had a tree fall in their house, and found out that the insurance agent changed the insurance policy, that they weren't going to color match the siding on the siding that they replaced anymore. And my parents had no idea about this. So, they called the insurance company to get the siding fixed where the siding got ripped off the house, and it's just different color there, right? And, it's all those types of things are things you have to pay attention to, right? I mean, that's going to affect the resale value of the house. That's, again, kind of pigging back what we talked about earlier in this episode. It's one of the reasons we brought in, other lines of business like the property and casualty insurance arm to review your policies. That's a huge part of your plan. If you're a homeowner, a home is a huge asset in your financial plan, and you want to make sure that's protected.
Interest rates. What are you telling your clients? Many of them have interest rates at 2.5%, 3%, maybe 3.5%, right? Because interest rates were low 2 years ago. We've seen interest rates hit upwards of 8%, come back down a little bit off of that. We don't know exactly where they're going to go, but kind of overall, what are you trying to talk about with clients and help them understand with interest rates when it comes to how much should I put down on my house? Should I just pay it all off, or should I still keep money on the house? What are the couple of factors we're thinking about when we think about actually paying off in a house, and rather than keeping a mortgage at say 7.5%, which is a pretty high rate.
Yeah.
You know, it's not like 2.5% where we can say, well, keep it at 2.5, and you know, over 30 years in a invested portfolio, I should beat 2.5%, right? How do we think about that concept with clients going, well, at 7.5%?
Yeah, I personally, I think 7.5 probably want to make some extra payments on that. Try to pay that principal down a little quicker.
It's just a much bigger hurdle rate, right? To get over, you got to earn over 7.5 to be in the black on it.
And I don't think it's either or. I don't think it's I have a 7% mortgage rate, so I have to stop investing. Right? I don't think that's the answer.
Mm-hmm.
But if you're growing your savings account and you're sitting on 18 months of your monthly spend in a savings account, maybe instead of buying another bank CD that pays you 4%, you should pay your mortgage off.
Right. Two ways to build net worth: increase your assets, reduce your liabilities.
I personally, unless the mortgage debt is 3.5% or lower, I do not like to see clients go into retirement with mortgages. I think it adds a level of fragility to their income stream when you have that payment that has to come out.
Mm-hmm.
I look at the clients we work with, the ones who don't have liabilities and don't have monthly payments and don't have things that they have to do are the highest. They're the happiest. They're the ones who they can get up and go. They can do whatever they want. They don't need to be so strapped down.
I think the other thing we always kind of want to keep in mind, right? How much liquidity do we have, and where is that money? If paying off the house to get rid of the 7.5% mortgage rate means draining all of your non-retirement, your after-tax assets, then we're probably going to say that liquidity flexibility is more important than paying off that entire debt.
Yes. Optionality is huge in financial planning.
Right.
Absolutely.
We have a client we work with that has, they bought a house, they're retired, all their money come from qualified accounts, they don't have tax diversity. Their mortgage rate's like 6, I think. Well, that 6% mortgage isn't really 6% when you adjust for the tax cost of paying that, $3,800 payment a month. That 6% mortgage, it's, closer to 8. Right, when you adjust for the taxes, and your mortgage broker is going to tell you that you can write off the mortgage interest income, and but first of all, you have to itemize. Second of all, you're still paying the money. It's not like it's free.
But you're stuck because if you pull out money out of that retirement account, you're going to end up paying a much higher tax bracket. You are just stuck.
Yeah.
Right, and that's where I think one of the biggest things that you're going to see us harp on this show, but also with our clients, is make sure you're planning your assets and where they are intentionally. Really like that word these days, intentional. Be intentional about everything you do. Because one of the other things, I'll circle back a little bit, when it comes to home ownership that everyone forgets, and all the hidden costs. One is literally just keeping up with what's in style, right? I mean, how often do we have clients that are remodeling because they just want it to look better? They want it to look different.
There's always something to add.
There's always something, right? You can always see what the new trend is,
right?
In order to spend your money.
I think my mother said she's going to sell the house like 4 times in the last 10 years, and then she just remodels it and ends up liking it again. So I'm going to remodel the kitchen and get ready to sell the house, and then there they are.
I like it so much. Why would I sell it?
We did all this work.
We did all this work. We paid all this money.
Yeah.
Speaking of trends, none of us are sitting here with a Stanley Cup.
Probably not going to be the Wild this year either.
Right.
Not the Wild either. No, not the Stanley Cup in the NHL.
The best trophy in sports.
The best trophy in sports. I don't think my Minnesota Wild are going to get that this year.
Nope.
Probably not next year.
Probably not ever.
Anyways, they will.
Okay.
They got a few years to get through some cap space that we got to get through, and we got a lot of young talent. We're going to get there.
Vikings too.
Absolutely.
Okay.
Oh my gosh.
The Vikings are going to win a Super Bowl, and the Minnesota Wild are going to win a Stanley Cup
in the same year
before
we die, maybe.
the Packers make it to the Super Bowl again.
All right, well, now you're just talking foolishly.
Anyways,
Statistically speaking, that's improbable.
statistically speaking, it's pretty improbable that the Vikings haven't won one yet. So,
Well, they've been defying the odds for many years. So they shall continue to do so.
Exactly.
All right.
All right. Stanley Cups, though. I mean, trends, right? I think this is a really simple concept, but for a lot of our clients, for everyone, for us, it's really easy to get on this. Oh, I gotta have the latest and greatest thing. I mean, the fact that Stanley Cups went from, I think, what's the statistic? They had 77 million of business 2 years ago, and this last year they're finishing with 750 million in revenue, purely because they started marketing the way they market their Quencher Cup, and it's just taken off, and it's like the latest, greatest. Everyone's got to have it. If you go to the gym, you're seeing them everywhere. They come in all sorts of colors.
Do they keep your water cold?
Yeah.
I think they keep your water cold.
Okay.
I'm not sure what happened to the Yetis.
Pretty spendy.
I mean, it used to be the Yetis a few years ago, right? Are they out?
I don't know.
Are they out?
I don't know. I don't have a Stanley or a Yeti, actually, so I'm a simple man.
I think it's just a prime example of getting caught up in spending your money in ways that you don't need to.
Right.
I mean,
Magic of marketing.
a cup is a cup. I don't think it's
It's a status symbol.
It is, but it shouldn't be. I mean, I think that's a very good thing to talk about with clients. Again, we're going to go back, pull out the word intentional again.
Yeah.
Be intentional with how you're spending money.
Yeah.
Just purchasing a Stanley Cup really have, does that really, is that accomplishing your goals or what you want to have?
Mm-hmm.
Or are you better off, being more intentional with when and how you're going to spend your money? And I think that's a big thing that an advisor should be helping their clients with, is thinking about, hey, not just how do we save, but how do we spend our money?
It's the other half of the equation.
That's absolutely, and I think that's that gets, forgotten about, right? And I think it's really important to make sure, if you have saved up money, don't just spend as much as you need to spend, the bare minimum. Right. Know how much that you can intentionally spend, and figure out what those goals are and what those dreams are and what those things, things you can do to improve your life, to make you, enjoy life, that you really have a passion about, whether that's going on a trip, spending more time with family, kids, grandkids, whatever it may be. Maybe it's a project.
Maybe it's a Stanley Cup.
Maybe it's a Stanley Cup. But maybe it's a project or a hobby you have, right? And don't be afraid to spend your money. I think a lot of people, that's a big transition of going from saving your money to spending your money.
I think
account balance grows, account balance starts to suddenly drop.
One of the roles of an advisor, in my opinion, that we always tell us clients, it's helping spenders save and savers spend. Spending habits are formed in your upbringing years mostly, and they're hard to start to transition, start to spend money when you don't have money coming in, like you said. Giving clients permission to spend is the other side of that equation. That happens a lot. If you want a Stanley Cup and you can afford a Stanley Cup, go get one. But at the same time, if
it's going to sit in your cabinet for forever.
They say, I'd rather look at it now than need it later. So there's a lot of that out there, right?
Yeah.
We see that all the time. I would say more often with a lot of our clients, they've, especially the business owner clients, accumulated a lot of wealth because they consistently saved. They consistently saved because they didn't spend a ton of money relative to what they were making. Not all of our wealthiest clients made a ton of money when they were younger. They just consistently saved and invested. And those frugal spending habits stick with people into retirement.
Right.
It happens more often than not, and especially on the business owner side, a lot of times they're too busy to running the business to go on family trips and to spend the money doing things. So it's important that for that type of client that your advisor's pushing you to do what you want, do things that are meaningful for you.
Be intentional.
Yes.
We have a blog post I just wrote. It's out there. It's be intentional. Mm-hmm. Business owners, if you're a small business owner, you're an entrepreneur starting up, we get it. We're in the same spot. We're business owners ourselves. There is always things to do. If you go look in my office, I've got a list. It never goes away. There are always things that we can be working on. Be intentional, because the only thing that you can't get more of is time. And I think it's really important to be very intentional about how much time you spend at work, with your family, and doing the things you love. Work should not be number one. You can love work, but I don't know anyone where they would put work as their number one thing they love. It's going to be their family, their friends, and doing the things they love. And it's great to love what you do, but don't let that consume you. So we'll talk about this a little bit more in the next episode too. I'll kind of reference the blog that I put up on this, and just kind of some key takeaways as to how you can continue to grow your business, but be more intentional. Why can't I say the word? Intentional with what you're doing.
Yeah, for sure.
Don't think the goal is to cross everything off of your list, your to-do list at work, because that's not going to happen if you're running a thriving business or a growing business. That's just not going to happen.
Right. I think Dave always says that all we have is three things. We have time, talent, and treasure. Talent and treasure you can get more of. Time is the only thing you can't get back, so make sure you're being intentional.
Time's the only scarce or the truest scarce asset, right?
Absolutely.
And Viking Super Bowl rings.
Right.
Very, very much so. Well, on that note, that wraps up the second episode of the podcast. We look forward to having you all on next time.
Thanks for tuning in.
Thank you.